Hi there, my name is Brett and I'm here to talk to you about California Ballot Proposition 5. Before we get started, an important disclaimer. I am a real estate professional. However, I am speaking to you today not as a real estate agent, but as a citizen concerned with a piece of legislation. The views I express here are solely my own and are not meant to represent the views of my team, my company, my industry, or any professional trade organizations to which I belong. Now that we've got that out of the way, what is Prop 5, what does it do, and what might its impact be? Well, Prop 5 is a ballot proposition which would modify existing provisions to the tax code to allow homeowners 55 and over, the severely disabled, and those affected by disasters to be able to transfer their tax base regardless of the new home's value, its location in the state, or whether the homeowner had done a basis transfer before. Now we're going to unpack that all. But first, the stated goal of Prop 5 is to incentivize seniors and the disabled to move, thus freeing up housing stock for people to buy. The idea is that people covered under Prop 5 are trapped in their homes because they couldn't afford the change in property taxes if they moved. Now some quick background to make sure that we all have a level footing with this discussion. Property taxes are taxes levied against property owners at a yearly rate of 1% of purchase price with an increase of no more than around 2% per year. Property taxes are vitally important because they are a huge component of what pays for schools, county and city level programs, fire protection, and more. The idea of people being trapped by low taxes is born of the fact that buying or selling a home triggers a reassessment, meaning that someone selling a home could end up with a much higher tax bill when they buy somewhere else because of higher property values, which generally grow at a pace faster than inflation or that 2% cap in California. Let me highlight a couple of important propositions which are already part of our law today. Prop 60, passed in 1986, allowed homeowners over the age of 55 to transfer the assessed value or tax basis of their home once per lifetime when they sell their home and buy another, provided that all the following are true. It's their primary residence, it is of equal or lesser value with their original property, it is in the same county, and the purchase is conducted within 2 years of the sale of the current property. Now that's kind of hard to wrap your head around, so let's do a quick illustration to make sure that you understand what that means. In the example given here, a 55-year-old couple bought a home 30 years ago for $110,000, and over the years, their property tax basis has risen to up to $200,000, and now they're looking to sell. Their yearly tax bill is around $2,200 a year. Now they have a choice to make. If they step up to a house that costs $700,000, well, then their new tax basis is going to be $700,000, which means that their yearly tax bill is $7,700. That's a $5,500 a year increase in their property taxes. But what if they step down? Well, if they stepped down to a house that was $450,000, then their new home's taxable value would still be $200,000 because they transferred it from their old home. Thus, their yearly property tax bill would still be $2,200 a year. Great for them. Now, another important proposition to understand is Prop 90, which passed in 1988. That changed these same county rules so that counties could adopt legislation allowing out-of-area basis transfers for homeowners 55 and over. 11 counties have done so far, and they're listed and mapped here. Now lastly, I want to mention Prop 110, passed in 1990. That extended the Prop 60 ability to transfer tax basis to the severely or permanently disabled, and it had no restrictions on the number of times it could be used. So now that we have some context, let's take a look at the actual provisions themselves in Prop 5. Here are the most important ones. It would allow eligible persons to transfer their tax basis any number of times rather than just one time in their lifetime. Secondly, it would remove the ability of counties to have any say in whether or not to accept the basis transfer. That basically means that all counties are opting in by default. Lastly, it would allow homeowners to transfer basis regardless of the value of the new property according to the following formula. You'll notice there's both an upward and a downward adjustment formula. And to see those in action, let's do another quick example. Now we're back to the same couple as before, and their tax basis of $200,000 is now in jeopardy because they've sold their home for $600,000 and they're buying something else. They have a choice to make as to whether to buy a more expensive home or a less expensive home. Now recall in the previous example, when they bought a more expensive home, they had the tax basis of that home. So when they bought that $700,000 house, they had a $700,000 basis. But in this case, using the new formula, they have a $300,000 tax basis. So they're paying less than half of the regular tax rate for that property. And for a less expensive home, it gets even better, because if they step down, they pay a percentage of what their previous tax bill was, so their new tax basis, even though the home is more expensive than the tax basis of their old property, is now down to $150,000. I do hope that makes sense. Please pause it and take a look at it if it doesn't. Now, taking a look at these provisions, it's the upward adjustment provision that really gives me some trouble. If a stated purpose of the proposition is to allow elderly homeowners to safely downsize, then this provision doesn't really make any sense. It only makes sense in the context of qualifying persons wanting to use the provision to give themselves a tax break on property taxes as they continue to move after 55. Now let's take a look at the fiscal impact of this. The nonpartisan State Legislative Analyst's Office estimates that schools would lose revenue thanks to this proposition. It would start off at around $100 million per year, growing an additional $100 million per year before settling at around $1 billion per year lost to schools. Doing a very rough back-of-the-envelope calculation based on publicly available figures from the National Association of State Budget Officers, this equates to an eventual revenue loss of around 2.8% of the cost of California schools. This can be kind of a scary proposition since we are already having problems with the funding of public schools in some areas. These costs will need to be made up by funding at the state level, and this part's speculation, but states may decide to cut budgets a bit, specifically to make things balance out. This revenue loss would be mirrored across to local government fire prevention and other programs. These could be huge losses to programs which might already be running against funding issues. Now, this section's a little bit more speculative, but I want to think about the economic impact of this. So again, please note that this is purely speculative, but the basis transfer provision increases the buying power of sellers who are able to transfer their tax basis. This is because buying power is in many ways a function of the size of your monthly payments. If you're able to pay $200 a month less in property taxes, you might be able to afford proportionally more in mortgage payments. This means that somebody who could afford a house at $700,000 with a standard tax rate might be able to afford $750,000 with a reduced tax base. So in this way, by increasing the buying power of a segment of home buyers, you increase their competitiveness, and the net effect might be to increase the price of homes, exacerbating the already prevalent issue of home affordability in California. And even if this scenario is avoided, there's an uncomfortable reality here. Most people who sell a home are buying another one, and that means that while this legislation may lead to more homes on the market, it might also increase the number of buyers looking for homes. And these additional buyers would enjoy a competitive advantage that individuals not covered by Prop 5 couldn't really hope to match. The core issue of the California housing crisis is a problem of limited supply, and it cannot be fixed by trying to shuffle around existing housing stock. Now, very briefly, I want to take a look at where is the money coming from for the for and against Prop 5 crowds. So first, against Prop 5. They've raised $3,070,000, and their top donors are listed here. Now you'll notice that the opposition is largely composed of public service organizations. And again, I'm going to speculate here. If I had to speculate on motivation, these groups represent public employees who are going to see the impact of revenue loss projected by Prop 5. Now looking at for Prop 5, you'll see that $13.2 million has been donated. That's almost a 4-to-1 advantage over against Prop 5. However, it's come from two donors solely, namely the National Association of Realtors, who donated $3 million, and the California Association of Realtors Issues Mobilization PAC, who donated $10.2 million. Now, an important point about that $10.2 million. This outweighs their total spending between 2011 and 2014 by more than $2 million. This makes this a huge investment for them, and make no mistake, this is an investment in policy. You see, a key effect of Prop 5 would be an increase in the number of transactions each year. And homeowners definitely do benefit from increased mobility. However, some of the biggest benefactors of an ecosystem where sales are more common are real estate professionals themselves. More transactions means more money siphoned out of equity into the real estate professional market. If you live in California, then there's a good chance that your life has been affected positively or negatively by house values. The stark truth is that we have a critical shortage of housing stock, and everything I've seen indicates that there is no influx of new homes on the horizon that are going to alleviate things. We all want a solution to this problem, but this, I don't feel like it's it. Seniors, the disabled, and those affected by disaster are already provided for by generous provisions in the tax code. We have a supply issue. More transactions per year benefits a fraction of homeowners and real estate professionals while doing nothing to fix the underlying issues. It's my considered opinion that the cost of this ballot measure is just too high. Now, regardless of whether you agree with me or not, when you're standing in that booth in November, I ask that you vote, and I ask that you vote your conscience. Thank you so much for your time, and have a wonderful day.